If you have an individual stock position with a massive unrealized capital gain, I'm going to tell you all about how you can exit the position without incurring capital gains through an exchange fund. And no, that's not the same as an exchange traded fund. You don't want to miss today's episode. If it's your first time here, my name is John Boyd. I'm a certified financial planner. I'm the founder and lead wealth advisor at Modern Wealth. That's Modern spelt with no vowels wealth. We're a fiduciary, fee-only financial planning firm located in Scottsdale, Arizona, but we serve clients virtually all over the country. And I'm so glad that you're here today because we have a good one for you. So I don't think this strategy gets talked about enough, partially due to the fact that when you go on places like YouTube and you look up exchange fund, you're going to get a bunch of results for an exchange traded fund or an ETF. And while an exchange fund is a broad basket of securities, it's not quite the same thing. And you're going to see why in a moment. In a nutshell, this is what an exchange fund is. Let's say that you have an individual stock position. It has a massive capital gain. Let's say you bought in for $100,000 and you're sitting on a $400,000 capital gain. And you do not want to sell and incur capital gains. But at the same time, this individual stock position consumes a large part of your portfolio, right? You want diversification. You don't want your entire net worth or a large majority of your net worth riding on this individual stock position. Well, what you can go ahead and do is swap your shares of this concentrated stock position with shares of an exchange fund. Now, what's inside of the exchange fund is generally you're going to have around 80% liquid securities, and usually it's going to be a broad basket, let's say that replicates the S&P 500. And then the other 20% is going to be illiquid assets. Generally speaking, that's going to be stuff like real estate. When you do that, you are going to go ahead and defer any gains that you have. And at the end of a 7-year hold, that's a key, remember, 7-year hold. At the end of that 7-year hold, you can then sell or exit the exchange fund at that time. So again, it does require you to ride it out inside of the exchange fund for some time to actually get all that deferral, but it's entirely possible to do it. So prior to starting Modern Wealth, I worked a lot with tech employees in the Seattle and San Francisco area. And these individuals would oftentimes have tech positions from IPOs or RSUs or whatever it may be. And with how tech has done over the last, call it 13 years, some of these stock positions would be humongous. They'd be massive. And when you look at how much of their net worth these stock positions consumed, oftentimes it would be 50, 60, 70% of their total net worth. I mean, there was times where I saw these stock positions literally consume over 90% of these individual net worths. I mean, it was crazy. And while, yes, some of these people, were all in on their company and didn't want to diversify, many of them did. But the problem is that selling would mean pretty significant capital gains. And so the exchange fund allowed us to defer those gains and on top of that, accomplish diversification now. So again, why would you want to use an exchange fund? Number one, you get immediate diversification. I'd say that is, generally speaking, the number one reason why you would want to use an exchange fund. You need diversification, and you don't want to incur a bunch of capital gains to get diversification. So this solves the issue of immediate diversification. The second reason why you would want to utilize an exchange fund is, of course, that tax deferral. You don't have to pay any capital gains now, and you receive funds in a position that can continue to grow. And then later on down the road, you can deal with the capital gains issues. Third reason why you'd want to use an exchange fund is that it is step up eligible. The fourth reason why that you would want to utilize an exchange fund is that you have a little bit more time, right? You're buying yourself time to tactically trim the position, right? Because again, the key here is that it's tax deferral. You're merely kicking the tax bill that you will ultimately pay on this position. You're kicking it down the road. You're getting immediate diversification, which is good. But ultimately, when you trim from this exchange fund 7 years down the road, you will have to deal with capital gains then. But the idea here is that hopefully later on down the road, maybe you're in a lower tax bracket. So when I've utilized the exchange fund, the conversation that I was having with folks is, hey, in 7 years, if you plan on pursuing early retirement or doing part-time work, whatever it is, we can start trimming from the exchange fund because you're going to be in a much lower tax bracket. And so when we trim and incur capital gains, then it's not that big of a deal, right? So we're buying ourselves time to do tactical selling later on down the road. So we've talked about, some of the good with an exchange fund. What are some of the bad things that we need to be aware of? Well, number one, high minimums, right? This isn't a strategy that, if you casually just have like a $5,000-$6,000 gain and you don't want to pay it, this isn't the type of strategy for you. Generally speaking, these exchange funds usually have pretty high minimums. Sometimes it's $500,000. Other funds have $1 million minimums. So oftentimes when I've used it, we're talking multi-million dollar positions in a concentrated stock. And it doesn't mean that you have to put all the stock in there, but you do have to be aware that to even utilize the fund, you're going to have to meet the fund's requirements. Second bad thing about exchange fund, and we already kind of touched on it, is that it is tax deferral, right? The capital gain isn't disappearing. You're merely kicking it down the road. You are getting diversification, but you are kicking it down the road. The third downside with an exchange fund is obviously these aren't free, right? Managers that create these exchange funds, there's going to be fees associated with them. Sometimes they can be a little bit more expensive. So you need to be aware of that if you are thinking about utilizing an exchange fund. So there you have it, guys. An exchange fund can be a really creative tool to break up individual stock risk within the portfolio. I would say for folks that have pretty significant concentrations, these type of strategies can work really, really well to help reduce that concentration risk, give you immediate diversification, and then we can do some tax planning later on down the road to figure out the tax liability. Smaller concentrations that are not necessarily multi-million dollar positions, maybe they're only like a couple $100,000. There are other strategies that you can pursue, and we'll make some videos on those down the road. I hope you found this helpful. If you are looking for more in-depth tax and financial planning advice, we are still taking on new clients. Reach out to us, www.modernwealth.com. That's modern spelled with no vowels, wealth.com. We'll see you next time.